Does your family ever get exasperated with you for stockpiling such things as paper towels, bottled water, or toilet tissue? Well, they certainly can't object to you stockpiling money. Silver, the only money recognized by the U.S. Constitution, and your first 10-ounce bar of pure silver can be had at spot price with no premium by going to sdbullion.com/rp. And when you buy it that way, you'll be supporting Reluctant Preppers as well by going to sdbullion.com/rp. Thanks! This is a quick update to thank you for building our number of patrons to 76 and growing on patreon.com/reluctantpreppers. Soon, when we reach 100 active patrons, we're going to start sending out a 1-ounce U.S. Silver Eagle each and every month to one active subscriber, so you don't want to miss out on that.
Please help us grow by subscribing today at patreon.com/reluctantpreppers.
As a responsible person with growing concerns for your privacy and personal liberty, you want to know where we're headed and what you can do about it. We ask the experts what you need to do to take prudent and responsible action to safeguard your family's wealth and well-being, and what basic first steps will help you to be aware and prepared. ReluctantPreppers.com.
Welcome back, Reluctant Preppers. We're glad to have a returning guest tonight. Matt from SilverFortune is here with us for a second time here on Reluctant Preppers. Matt, thank you for joining us again.
Hey, thanks for having me on again. I had a great time last time, and I think we're going to have some great discussions in this interview today.
It's been an eventful couple of months since we spoke last, and your last interview here was well received by our viewers, so they're eager for you to come back on. We've had a lot of volatility around the world in hot spots. People sometimes refer to them as emerging market economies, that sort of thing, but they certainly are points of potential upset in the system and sort of vectors of change. Can you kind of give us what you think are some of the most important examples that we need to be paying attention to and why they're significant to our future, even though they may seem half a world away?
Yeah, absolutely. You know, for the last week or two, the spotlight has, to some extent, been taken off of emerging markets. And when I say emerging markets, the countries at the top of the list right now, the important ones, I should say, they're all important. But Turkey, Brazil, Argentina, South Africa, and there's some other ones that are slowly being added to that list, countries like India, Indonesia, and there's other ones that potentially still could be added in the future, countries like Poland or Mexico. These emerging markets, they haven't had as bad of last couple of weeks as well, the weeks or months before that. And that's largely due to the U.S. dollar index kind of taking a breather in terms of its strength. But with that being said, we are still seeing a lot of weakness in these economies and their currencies, their markets, bond markets, stock markets, you name it. They're really suffering. Even India, which is certainly in a better position than a lot of those countries right now. That the Indian rupee is, which is a relatively large currency compared to say maybe like the Argentine peso. It's right around record lows right now. And so this emerging market crisis, I think, it's far from over. We talked about this in the last discussion, some of the big reasons that this crisis exists in the first place. I mean, part of it is these countries, their economies taking on too much debt in foreign currencies, oftentimes U.S. dollars or euros in the case of some countries that are, geographically located near the Eurozone, such as Turkey. That's a big part of it. But the reason that it's gotten so much worse, that debt is actually starting to matter, is the Fed tightening as well as the U.S. government issuing more and more debt, more and more bonds. And those two things, I mean, we saw the Fed tighten today, and we know that the U.S. government is not going to stop taking on more and more debt anytime soon. Those things haven't changed. And so I don't think we've seen the last of this emerging market crisis. We've just kind of seen it kind of be removed from the daily or the weekly news cycle or financial news cycle for the time being. I think it's going to get much worse. And to answer that question, why does this matter? Why does what's going on in Argentina or Brazil or Turkey or eventually India, Indonesia, Pakistan, Mexico, why does that matter in the United States? Well, as I said, a lot of these countries, especially at the corporate level, companies have taken out loans in foreign currencies. Again, oftentimes U.S. dollar or euro, which for the time being are relatively stable currencies. Okay. for years, a lot of corporations, they basically made a large bet. I mean, they needed to take out debt, and sometimes it's easier to get foreign currency lending or funding through foreign currency debt. But they're kind of betting, in a sense, that the U.S. dollar would not grow in strength, that it wasn't going to have a lot of strength, that it wasn't going to at least have the strength that we've seen recently. Well, it has. Again, going back to the Fed tightening, the U.S. government policy. So the dollar has had this strength, and all of a sudden, these debts that they owe are a lot harder to pay because it's in a stronger currency. Now, of course, who do they owe those debts to? Well, in the case of a country like Turkey, they owe them to banks. These corporations owe the money to banks in places like the United States, Spain, other very vulnerable, banks within very vulnerable European economies. And the same goes for all these other emerging markets. When they're taking on this debt in a foreign currency, it oftentimes is not being done through a domestic bank. It's being done through a foreign bank, oftentimes a U.S. bank or European bank. And so, eventually, if you have a country like Turkey or Argentina that's undergone a massive currency depreciation in the last couple of months, and all of a sudden you have these corporations that owe billions and billions of dollars in debt to these banks, if they suddenly can no longer make those payments, if they default on that, who's really going to pay the price? I mean, those economies certainly will, but imagine what it's going to do to the banks, right? And so that's how it kind of affects us. I mean, never mind just economic weakness. I'll get to that in a second. But the defaults on that debt, that affects our banking system and in turn our whole financial system, our markets, and our economy. Now, the other piece of it is also just economic weakness in these foreign countries. I talked about this in a video today. People have this sense that somehow the United States today can be some sort of a shining beacon of economic strength in a sea of countries that are just drowning in debt and poor economic growth, and et cetera. But what I basically said in that video is that no, I mean, that whole idea that we can be a beacon of economic growth, that's an idea taken from like the post-World War II era, the late 40s, early 50s. But of course, back then, the U.S. was in a relatively strong position. We were one of the few, probably the only considerably sized economy that left that war unscathed. You had the UK, you had France, almost all of Europe, honestly. You had the Soviet Union, you had China, the Koreas, of course, we had the Korean War shortly after, Japan, the Philippines, you can go on and on. All of these major economies were bombed, right? They had a war that was fought on their land, and the United States, for the most part, we didn't have to deal with that. Today is a totally different story. Our economy is just as rotten to the core as European economies, as emerging market economies. We have a ton of debt. We have a very bleak demographic situation in the sense that our population is getting older and older and less productive. We have inflation that is well outpacing wage growth. We have all these problems. It's just not the case that we can somehow avoid that same economic weakness that we are soon going to see in all of these emerging markets.
So what you're saying, it sounds like, if I can summarize that and tell me what I'm missing, is first of all, we have to pay attention to these emerging markets because they can be the stone that gets pulled out underneath one of these banks, that all these banks are connected, and it can start a domino effect, and so what contagion can spread from what appears to be a smaller distant starting point. That's number one. And number two, they is us. What we see them, they may be just a little bit further down the, whether you want to call it the learning curve or the decay curve or whatever, they may be closer to that fringe, but we're in not much better shape in some ways than they are, subject to some of the same structural weaknesses.
Yeah, I mean, that's an excellent way of summing it up. I mean, basically, contagions, like you said, they don't start from the center. I mean, the 2008 crisis did not begin in the heart of the money markets or something like that. No, it started on the fringe. It started with things like the subprime market, which was just a small segment of the whole picture, and yet it spread. And when you have, and this is a topic for a whole nother video, but when you have a system that is so highly leveraged and so reliant on derivatives, it doesn't take a whole lot of defaults, of somebody rocking the boat for it to turn into a full-blown contagion. Now, I don't know if that's for sure going to happen as a result of this emerging market crisis. People say that governments can step in and stop something like that from really spreading, and they're not entirely wrong, over the short term. But the banking contagion is one thing, but the economic weakness spreading into other countries, kind of the second point. That is not something you can necessarily fix with a couple $100 billion worth of IMF bailouts or something along those lines.
Wanted to whet the viewers' appetite. We just recently did a Reluctant Preppers road trip to some emerging market countries, including Italy and Greece and Montenegro were within the EU zone, and then also Croatia, which is outside where they don't have the euro as their currency, and interviewed quite a few people in different walks of life there about how things are affecting them politically and economically, so people can look forward to us sharing that in a travel blog coming up soon. And in passing, you mentioned the Fed turning to a tightening bias, and if you could give us your view of why that's significant, or whether you think it's actually real, or is that just window dressing for posturing reasons, or what do you think the real effects of that are going to play out to be?
Yeah, I mean, that's a great question. I mean, the Fed, they raised their interest rates once again today. I think this is the 8th rate hike since Janet Yellen raised rates for the first time since the Great Recession in 2015. So 8 rate hikes now. We're up to around 2% for the Fed funds rate. Jerome Powell has thus far kind of been a man of his word in his 8-month tenure, however long he's been the Fed chair now. He has tightened. He's stayed the course on this. He's certainly been much more hawkish than I think Janet Yellen would have been. Do I think the Fed is for real with this tightening? That's hard for me to answer. I mean, because honestly, I would need to see inside the mind of the Fed chairman and all the voting members. We can come up with a couple different possibilities. Either Jerome Powell and others are entirely naive. I was watching I was listening to this interview actually on NPR. Yes, I listen to NPR from time to time, and there's this guy on there. He's their market guy. He's their economy guy, and he's a bit of a cheerleader for the Fed. And he would fit in well on like the CNBC. He just cheers on the markets a lot of days and the Fed and et cetera. But he was actually interviewing Jerome Powell and talking about this. And I was listening to Jerome Powell, and I was just like, are you kidding me? Like, are you intentionally deceiving us in saying this, or are you just so caught up and infatuated with your own position, your own power, that you just are blind to this? But basically what he was saying was, Kai had asked him, why are you continuing on this tightening cycle? And he basically said, well, we need to keep hiking interest rates because, some different data has shown us that the U.S. economy is overheating, and we're running the risk of bubbles forming and imbalances forming. And I'm like, are you kidding me? Like, we've been in a bubble economy for a long time. You have asset bubbles in the stock market by many metrics around all-time highs, certainly around .com bubble highs, 1929 highs. You have the real estate market, which might not be as big of a bubble, especially with millennials such as myself, just not having the means to purchase houses when past generations have, but still in a bubble, especially certain markets. And then you have debt bubbles, which have also been fueled by the Fed's past policy. You have the student loan bubble. You have auto, credit card, mortgage. You have kind of the biggest bubble of them all, perhaps. You have corporate debt, but you also have the biggest one of them all, the sovereign debt bubble. These imbalances, these bubbles are already here, and he's trying to prevent them from forming. Again, either he's naive or he's intentionally deceiving us. That's the way I see it, and they know the ultimate. That they already know the ultimate implications of their actions right now, this tightening cycle. And so, I couldn't say for sure exactly what they're exactly trying to do. But looking at the facts, it's almost always the case that the Fed creates bubbles through keeping their policy too loose for too long. That's what they did following 2008, kept interest rates too low for too long. They did their quantitative easing, and then they go ahead and tighten too quickly for too long, tighten too much, and they pop the bubbles that they formed. Another crisis happens, and they swoop in and save the day. I mean, it's when you look at the long-term trend here, it's not hard to see that. And I think, if I can keep going here on this rant here about the Fed, I think their current path right now, most people, and when I say most people, I'm not talking about you and I, but I'm talking about people, maybe analysts, kind of more mainstream establishment traders, CNBC people, Kai Ryssdal, et cetera. They're expecting the Fed to, I don't know, keep their word and continue raising interest rates through 2019, even into 2020. They're going to continue to unwind their balance sheet until it's, quote unquote, normalized. That's probably another $2 trillion unwind from where it is right now. I don't know exactly what they'll consider normalized, but they take them at their word, and they think that they'll actually follow through on this. I think the reality of the situation is that, for a long time now, people have been kind of predicting the economy is going to collapse, or it's going to go down the drain or whatever because of high debt and whatever. But I think things like high debt and whatnot are beginning to matter as interest rates start to rise. And I think the Fed is kind of at the center of this. And I honestly think that the Fed is not going to be able to follow through with their plan of raising interest rates through 2019 into 2020. And they're not going to be able to normalize their balance sheet. I think that their pause in this tightening and an eventual reversal back into a loosening policy, it's going to happen a lot sooner than many people anticipate. I couldn't tell you exactly when, but heading into 2019, certainly after the midterms, looks like it could be a very ripe time for the markets to drop. This emerging market crisis probably will worsen by then. You have some other potential gray swans, because we can talk about them. How much can you talk about black swans? They're supposed to be unexpected, but there's plenty of other things that are on the horizon that could cause a catalyst for this to happen. The Fed is not just going to spontaneously reverse years worth of policy. They need a catalyst, a stock market crash, a financial crisis. And I think the next 12 months are looking very ripe for that. And it happening in the next 12 months, I think, would catch a lot of people off guard, in the sense that they expect the Fed to, this party to go on for at least a couple more years. But as often is the case, people don't realize we're in a recession or a depression until it's too late. That's a fact of the matter. That's what happened in 2008, and many other times throughout history. And I think it's going to happen this time around as well.
Still regarding the Fed tightening, some people have said that the real reason, and if you could address that for a moment, you mentioned it's comical to hear them say we're gonna tighten now because the economy is showing such signs of strength. We need to prevent bubbles because we've been in a bubble for a long time of multiple kinds. But what about the comment that some people have made that the real reason the Fed has to get the needle off of zero interest is because they need some ammunition to be able to prepare for the next recession when they're going to have to, or the worsening of the recession when they're going to have to be able to drop again? Because if they're already at zero when the economy needs a juice, then there's nowhere to go down from there.
Oh yeah, absolutely. I think that's a part of it as well. It also, I think, has to do with as important as their policy is and the interest rate changes and their balance sheet unwind, they also have to kind of keep up appearances. They have to kind of push the whole we have a strong, robust economy
narrative.
I guess narrative, correct. Thank you. Out there as well. And I think that's very important for market psychology as well. That's very important for financial conditions within the market. If we were in 2018 now and they still hadn't raised interest rates and they still hadn't begun their balance sheet unwind, I think the market probably would have called their bluff by now. They had to start at some point. And you're correct. Your viewers are correct in saying that, yeah, they need some room to breathe. But what's interesting about this is, if you look at the Fed funds rate, and let's say 2006, before the financial crisis, this was shortly after, I think, Greenspan had left office as Fed chairman. Bernanke was in. He got a couple rate hikes in before they paused. I don't know exactly. I don't have it right in front of me, but I want to say the Fed funds rate was around 5 or 6%. There's no way we're going to get that high this time around. Mm-hmm. And so you got to think that if this crisis is going to be just as bad, if not worse, the Fed's going to need to respond in kind or even more radically than they did last time. And so, negative interest rates that could be on the horizon. Certainly much more QE than they did last time. And of course, there's other tools that they can use as well. They can fund the government directly. Let's never mind them buying bonds. Let's just have them fund the government directly. You don't need to worry about interest rates lending all of that through the government. They can begin helicopter money policies, which I think would be extremely popular over the short term. They quite literally, not literally, drop the whole idea behind helicopter money. I think it was Milton Friedman that coined the term. It's a helicopter going over a city and dropping money out, right? Bringing money directly to the people rather than just corporations or whatever. I don't think it'd be a lot. In the whole scheme of things, corporations absolutely would benefit more from their policy, but I think it'd be popular over the short term. It's also going to be inflationary. That's the type of things that the Fed is, I think, going to have to do this next time around. They have built themselves somewhat of a cushion, but it's not nearly large enough for I think the crisis that they're eventually going to face.
If we could turn our attention now to the precious metals markets, a number of our viewers are very interested in reducing their risk to systemic exposure to risk of our fiat currency system by having precious metals in their own possession, and all that represents as far as a potential store of value and a hedge against a crisis. But recently, coming out of a 2-year pennant or flag formation of the price market, there was a pretty significant breakout to the downside for silver, and there's been a significant amount of questions on people's mind as far as where is there a floor underneath silver. People said that it was already under the cost of production for many producers when it's in the $13, $14, $15 range, and yet it seems that there's weakness ahead, or at least we're in the middle of that right now. Do you believe that there is a real floor under the silver price? And if so, where and why?
Yeah, well, first of all, you're absolutely right. Your viewers are absolutely right in saying that it's a way to protect themselves, get out of this fiat system. But also, I mean, if you look around in terms of investments, in terms of assets to own, where to put your money, if you are, I guess, of the same mind of I guess you or I, some in this alternative financial media or community, it's hard to find something that's not overvalued. And so never mind just the dollar and fiat currency being overvalued, but stocks, real estate, et cetera, they're overvalued as well. But yeah, talking about the floor in the price of silver, you're correct in saying that there are, I think, some miners that are under the cost of production now, which doesn't mean that they're immediately going to close up shop immediately. That's expensive to do that. And so they're going to operate under the cost of production for a limited amount of time. Now, in the whole scheme of things, I don't think we're not talking 20% of production, 50% or anything like that. No, it's a small amount, but with commodities, oftentimes the case is that, the price is set by the paper markets, but, in an ideal world, the price is set by the last ounce or the last barrel of oil, the last bushel of wheat that is sold. Meaning, if we relate this to the oil market, you have a lot of countries that are producing well under the price of oil right now. You have Saudi Arabia, et cetera. But the price is going to be much closer to the most expensive producers, whoever those are on the oil market. Same thing goes for silver. There's primary silver miners out there right now that as they close down, well, that's going to put an upward pressure on the price of silver because a small amount of supply, even if it's just 1%, 2%, 3% taken off the market, is going to affect the price, right? The price isn't just going to be able to stay low. Now talking about this floor, my thought on that, I see this heading in two different ways, I guess, over the next 6 months. First of all, I think, through the election, we could continue to see some choppiness in the markets. I'm not extremely bearish or bullish, though, on silver. When people talk about $12 silver, $10 silver, I am still highly doubtful of that. With that being said, in October or something like that, we could see silver back under $14 for a brief amount of time, but $13.50, $13, I think unlikely. But I do think we're going to see some dollar strength, some future dollar strength that would make that possible. With that being said, I think there's also some other things that will keep it from falling even more. There's this seasonality in the price of silver in the sense that around this time of year, it tends to go up, okay? There is the potential for things like a war in Syria. There's the election, which are going to cause some volatility and a bit of a fear trade into precious metals. And so, yeah, I think you're going to see some choppiness, but I don't think you're going to see a whole lot of lows until after the election. And this is an if. This is where I see kind of two different scenarios playing out. If the elections come and Democrats have themselves a good day at the polls, and they are able to maybe not, they don't even need to regain the House or the Senate, but let's say they make it close. It's at the end of the day, it's clear that they have won back some seats for their party. Then I think we're going to see some volatility. We're going to see the markets kind of upset about that. And I think we can say at that point that it's probably likely that the low will be in for silver and gold at that point. I just see it going up after that. We could see some short periods of high dollar strength and some sort of a crisis. We could see some weakness in the precious metals like we have in the past. But other than that, I don't think we're going to see a whole lot of lows. Now, the other scenario here is that Republicans have a good showing at the polls. They maintain control of the House, of the Senate. This whole mantra of great economic growth and everything under the Trump presidency continues for a little bit longer. And we head into December, which over the last couple of years at least has been a very poor month for silver and gold. And during that time, we could see new lows. We could see 1350. We could see 13 for a short period of time. But of course, January, end of December, February, March, those tend to be strong months for precious metals. And so I think they're going to rebound back up. So, I guess this is my thought on it is that, the lows that we saw a couple weeks ago when silver briefly dropped under $14, and a little bit before that, a couple weeks before that, we saw gold, I think, around 1165. Those are going to be pretty close to the lows. I don't think we're going to go a whole lot lower than that because I just don't see us being 12 months or 24 months away from a crisis or from the Fed loosening their policy again. And that's really the big signal that I'm looking for a bull market to return in precious metals, a catalyst from the Federal Reserve. There's plenty of other catalysts, black swan type things, but that's one that I think we can say with some amount of confidence it's going to happen inevitably, and that's going to lead to a very weak dollar. And it's going to lead to a lot of demand for precious metals, especially silver, which I think is much more sensitive to that type of demand. And it's going to be another run up. It's just a matter of when. And if it's another 12 months, 24 months, and I'm totally off base, then so be it. You, me, our viewers, we will have a little bit longer to purchase these metals at a very low price. But again, same story with the Fed. I think it's going to come a lot sooner than what many, I guess, establishment individuals believe.
I appreciate you giving us that balanced multiple scenario outlook. And I forgot to mention this in the beginning, folks. It is Wednesday, September 26, 2018. We're talking with Matt from SilverFortune. Matt, could you talk to people just briefly about where they can find you online and what kind of resources you provide there?
Yeah, I'm on YouTube. I'm also actually on podcasts, just about every podcast platform out there now, iTunes, Android, Spotify, Pocket Cast. There's some other ones out there, but my main home is here on YouTube, and as the name of my channel would suggest, I do have a heavy focus on silver and precious metals, but doesn't mean I can talk about them every single day on my channel. So I do talk about a lot of other topics that I'm passionate about, including the economy. You heard it, the monetary policy, Fed policy. Stock markets, bond markets. I document a lot about the things like that are just kind of going wrong in our society today in terms of growing wealth gaps and what's the real cause of that. What are some solutions to that, or the coming pension crisis, on and on. It might come off as a bit doomy gloomy, which I don't think a lot of your viewers would mind in the first place, but I think it's a lot of that needs to be spread out there. So SilverFortune on YouTube and on different podcast platforms. That's primarily where you guys are going to find me.
Well, Matt, thank you once again for joining us here this second time on Reluctant Preppers. We're going to have you back on to talk about some of those other major topics that you've broached there, because those are also of significant concern to our viewers. So thanks once again.
Yeah, absolutely. Thank you again for having me on today.